Property and Casualty License Exam Manual. Welcome to the quiz. What is a captive insurance company? Is it A, an insurer owned by its parent company to insure the parent's risks? Or B, an insurer that only writes policies for captive audiences? C, an insurer held captive by regulations? Or D, a small, local insurance company? The answer is A. A captive is a licensed insurance company owned and controlled by its parent organization or group to insure the risks of the parents. It allows customized coverage, risk retention, tax benefits, and reinsurance access. Not public sales. Not audience-related. Not regulation captive. Not just small/local. Captives provide self-insurance for the owner's own exposures. Next question. In inland marine insurance, what is a floater? Is it A, a policy or endorsement that covers property that is mobile or in transit, often regardless of location? Or B, a policy that floats between different insurers? C, coverage for property that floats on water? Or D, an additional premium charge? The answer is A. Inland marine floaters provide coverage for movable, portable, or high-value property that travels or is used away from a fixed location, e.g., personal articles floaters, jewelry, cameras, contractors' equipment floaters, installation floaters. Coverage often applies worldwide or wherever the property is. Not switching insurers. Not literal floating on water, that's ocean marine hull. Not premium charge. Floaters insure mobile/transient property exposures. Next question. What does proximate cause mean in determining whether a loss is covered? Is it A, the active, efficient cause that sets in motion a chain of events leading to a loss, without which the loss would not have occurred? Or B, the cause that happened last in time? C, the cause that is most convenient for the insurer to cover? Or D, the cause that is specifically named in the policy? The answer is A. In property and liability insurance, coverage often depends on what caused the loss. Proximate cause is the dominant, efficient, or primary cause that starts an unbroken chain of events leading directly to the damage, the one that, if removed, would prevent the loss. It is not necessarily the last event, immediate or direct cause, but the initiating force that naturally and continuously produces the result. For example, if lightning, covered, strikes and starts a fire that burns a building, lightning is the proximate cause even if smoke or heat is the final damage. Courts use this to decide if an excluded peril, e.g., flood, breaks the chain or if a covered peril dominates. Last in time ignores the root cause. Convenience to insurer has no role. Named perils are separate. Proximate cause applies broadly to determine the efficient cause in coverage disputes. Next question. What is the main purpose of a certificate of insurance? Is it A, to provide evidence that an insurance policy is in force? Or B, to serve as a legally binding insurance contract? C, to replace the actual insurance policy? Or D, to guarantee claims will be paid? The answer is A. Certificates are summary documents issued to third parties, like landlords, clients, or lenders, showing key policy details, who is insured, coverages, limits, effective dates, as proof that insurance exists and meets contract requirements. They aren't the policy itself, don't change terms, and aren't binding contracts or guarantees of payment. The certificate's main job is verification of coverage existence and basics for contractual proof. Next question. What does host liquor liability coverage pertain to? Is it A, liability arising from serving alcohol at a private event, e.g., a party, where no fee is charged? Or B, liability of a bar or restaurant? C, coverage for liquor inventory? Or D, an exclusion for all liquor-related liability? The answer is A. Standard CGL excludes most liquor liability if the insured is in the business of selling/serving alcohol. Host liquor liability, often an exception or endorsement, covers social hosts for BI/PD claims when they furnish alcohol at a private, non-commercial event, e.g., backyard party, wedding reception, without selling it. It does not cover commercial bars/restaurants. Those need liquor liability. Not inventory. Not full exclusion. Host liquor protects non-commercial hosts from liquor-related injury claims. Next question. What does pro rata liability mean when multiple policies cover the same loss? Is it A, each insurer pays a share of the loss in proportion to its policy limit relative to the total applicable limits? Or B, the insurer with the earliest policy inception date pays? C, the loss is divided equally among all insurers? Or D, the insured chooses which insurer pays? The answer is A. When multiple policies apply to the same loss without primary/excess designation, pro rata liability divides payment proportionally based on each policy's limit relative to the sum of all applicable limits, e.g., $100,000 limit out of $300,000 total pays 1/3. It ensures fair contribution. Not first in time. Not equal shares. Insured does not choose. Pro rata shares losses by limit size. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.